accounting principles, corporations, and stockholders' equity. Today, the learning objective is going to be reviewing the characteristics of a corporation. Now, a corporation has a separate legal existence. When you apply for corporation status through your state and you receive a charter for the corporation, you also will get a tax ID number, which is similar to a Social Security number. But that's going to allow the corporation to do things like buy and sell land, pay taxes, and a corporation can do anything except for vote that an individual could do. The ownership in a corporation is evidenced by shares of stock. When a investor buys shares of stocks, they actually become part owner of that corporation. By the buying and selling of stock has a couple of significant purposes of that. One is that it's an easy way for a business to raise funds. They can sell stock to investors and get money in without incurring any debt. And it's a pretty quick process. And there's also an ease of transfer of ownership. If a person wants to sell off their portion of the business, they just sell stock and the other party will assume that ownership of the business. Corporations have continuous life. A sole proprietorship, if that sole proprietor would die, many times the business ceases to exist. But a corporation, because of this unique structure, can continue on indefinitely. The major advantage of a corporation is called limited liability. And what that means is that the owners of the corporation are only liable up to the amount that they've invested in stock. If you're a sole proprietorship or a partner and your business incurs debts, you can be held responsible for those debts. But in a corporation, as a shareholder, if the corporation incurs some debts and don't pay it, well, if the corporation went bankrupt, the only thing that you would lose potentially is the amount that you invested in the purchase of stock. They can't come after you personally, can't go after your personal assets, and that is the main advantage why many small businesses incorporate in the first place. The earnings of a corporation, they're distributed to shareholders through dividends, and that's for investors, that's a recap of their invested amount. That's determined by the board of directors. The board of directors would declare a dividend, and those are paid out to the shareholders as the board of directors determines. Some disadvantages of a corporate form of business ownership is that there's increase in startup costs at the beginning of the year, to file for articles of incorporation, and different states have different fees involved with forming a corporation. The ownership of a corporation and the management are separated. The stockholders are the owners, but they're not involved in the day-to-day operations unless they happen to also be a manager of the corporation that owns stock or the president of the company that owns stock. But many other shareholders are not involved in the day-to-day operations of the business, and so there's a separation there. Another disadvantage of a corporation is just the ongoing requirements to maintain a corporation, filing requirements, separate tax returns, and so on. So there's an ongoing responsibility there in a corporate form that you don't have as a sole proprietorship. And another last disadvantage of a corporation is called double taxation. As I mentioned earlier, the dividends are paid out to the shareholders those dividends are taxable to those individuals. So that income is included on their 1040 form. They will be taxed on that. Also, the profits of the corporation before the dividends were distributed are taxed. So that income, in essence, has been taxed twice, once at the corporate level and then once at the individual level for those amounts that were distributed as dividends.